I'm going to perhaps give a slightly simpler approach, but probably echo a little bit of what Alex has said earlier about how to think about investing in this environment, indeed in any environment, because I think the one thing that we should all recognize is that we just don't really know what's going to happen. It's always tremendously entertaining to talk about the regime changes back and forth, up and down, but the reality of it is we just don't really know. I think the chart that Alex had about central bankers' inflation forecasts said it all, really. These people spend their whole time doing that, and they don't know. And I certainly don't claim to have any expertise in inflation regimes or indeed economic forecasting. What we try and do is focus much more at the company level, and to some extent we're much more constrained in terms of the tools available to us. So we're really just dealing with predominantly UK equities with a bit of overseas equities within a relatively plain vanilla framework. But within that, we're trying to do a lot of the same things that Alex is doing, which is to try and drive solid, consistent performance over the long term within the portfolio, be resilient on the downside, and also protect capital when life is difficult, but participate importantly in the upside opportunities as they present themselves. And that's really what we're trying to do within Dunedin. The portfolio's been around since 1873. It's the second oldest investment trust in the world. I'm sure some of you have got investments in F&C, which I think is the first one, founded a couple of years before. But Dunedin has been around for an awfully long time. It started off investing in North American railroad bonds. Today, it's investing predominantly in UK and overseas equities. But I think the focus on delivering income, protecting that in real terms over the longer term remains absolutely key. So what are we trying to do within the equity income space? Well, it's a very selective strategy. We have around 35 holdings within the portfolio, so pretty focused. And we're looking to find the best companies that we can within the UK and European markets, aiming to deliver growth in capital and income, and at the same time trying to meet our social and responsible investment criteria. So I think that is one of the things that really marks Dunedin out as quite different to a lot of other investment trusts, particularly within the equity income space, that we do have a sustainable and responsible investing overlay. And I'll talk about why we think that is still relevant, despite the fact that that seems to have got a lot of awfully bad press in recent times. So how are we managing it? Well, very much focusing on positive allocations. We want to put money into companies which we think can do really well over the long term. We select from across the market cap spectrum, so we're very flexible in terms of what we can invest in. We invest in companies like Chesnara at 300 million. We invest in companies such as Novo Nordisk at 200 billion. So we're able to invest across that market cap spectrum, and we're very comfortable with being different. Again, just to sort of echo Alex's comments earlier, we are very relaxed about being very different to the rest of the market and very different to the rest of our peers within the equity income space. We actively encourage ourselves to do that because we think if we have our best ideas and we're prepared to be very different, that's going to give us the best potential to outperform over the longer term. And what's the outcome? Well, the portfolio, I think, is the highest rated from an ESG perspective portfolio within the UK equity income space. It gets a AAA rating from MSCI. It offers a near 20% dividend yield premium to that which you can get on the marketplace. It's grown that dividend or held it. I think it's grown it in 38 of the 40 years and held it in the other 2 over the last 40 years. And it's delivered decent, attractive total returns and good relative returns over the last 3 and 5 years. So what makes us different? Well, first of all, that focus on total return. We're thinking about income, yes, absolutely, but we want to grow that income in real terms, and we also want to grow our capital in real terms, and it's getting that balance, which is really important. Active positioning, being prepared to be different, an active share of 85%, meaning that we only have 15% overlap with the FTSE All-Share, means that we're very different in terms of our positioning. Our income delivery has been extremely resilient, not just in terms of the dividend which we pay to you, which is that which has grown or been consistent over 40 years, but in terms of our own income generation. A good example would be back during 2020, during COVID. The income that the portfolio was able to generate from its investments fell by about 10%. The income that the market generated fell by about 40%. And that was due to our focus on higher quality companies that were more resilient and through our approach to diversification within our income generation. And also, I think important to point out our embedded sustainable and responsible investing principles, which we think play an important part in mitigating longer term risks within the portfolio. So it's a very selective strategy. We start out with an opportunity set of well over 1,000 companies across Europe. Of those, about 750 meet our sustainability criteria, so we screen out about 25%. Of those, there are about 200 which meet our pretty rigorous quality criteria. We do make some allowances in this strategy for yield, so we will own some high yield companies where they might not quite have the quality characteristics which we would expect in a sort of non-yield portfolio, but we still aim to select the very best quality we can find. We're then looking for the companies which we think offer really attractive total returns, and those are the ones that are buy rated by our team of analysts. And from that, then we're building a portfolio of somewhere between 30 and 50 stocks, and currently much more towards the 30 than the 50. So very focused, very concentrated. What does that mean in terms of the portfolio characteristics? So at the moment, sort of 38 holdings. That was at the end of July. If you looked at it today, it would be more around 35. Active share in the mid-80s, pretty high for a UK portfolio, particularly high for a UK equity income portfolio. 43% of the portfolio invested in below 10 billion market cap companies, so lots of exposure to the mid-cap part of the market. And the types of companies which we're investing in, generating better earnings than the marketplace. They make better returns, which allows them to be more resilient in even more challenging environments. And it's certainly going to be the case that we are going to go into a very challenging environment. And we think the companies we invest in are well positioned to manage that. In terms of the trade-off, we want to be able to participate in the upside opportunities and prove to be resilient in terms of the downside. And over the longer term, we've been able to comfortably outperform our benchmark after costs. In terms of that performance, over the 6 months, the strategy has more or less met the FTSE All Share. So despite all of that difference and all of the effort that we put into that, we've delivered exactly the same return as the FTSE All Share over the last 6 months. But given that the focus on sustainability of the strategy, given that our quality focus has shifted us away from a number of the banks that have done very well, and our sustainability criteria pushed us away from commodities as well, I think that's a pretty decent return relative to the marketplace. And over the longer term, the portfolio has been able to deliver quite consistently through what have been some quite choppy market conditions. What is our sustainable investing approach all about? Now, it's very much, I think, the case that particularly with the evolution of the developments in Russia and Ukraine, that investors have somewhat taken umbrage at ESG. ESG is blamed for causing shortages of energy. It's been blamed for a number of elements. But we actually think that a lot of the developments that have occurred over the last 6 to 8 months validate a focus on these areas as key risks that need to be considered. And Alex touched on some of those things and how they may impact the future going forward. But if we think about energy, the one thing that we can be absolutely sure is that in an environment where natural gas is being cut off in supply from Russia, that a focus on renewable and sustainable energy sources is going to be absolutely critical. So having investments that can take advantage of that type of situation, we think, is very important. In terms of the social side, again, what we've seen is unprecedented reactions both from government and from the public that has forced companies to completely divest whole parts of their businesses that have been exposed to Russia and the Ukraine. That cancel culture is not going away anywhere soon, and making sure you're on the right side of that is a very important element. And then governance has also played a key role, making sure that you're getting into bed, for want of a better phrase, with the right companies, with the right governance structure. Again, absolutely critical. Nothing could be clearer than if you've done business with the wrong people in the wrong countries, then that's going to have a negative impact for you as an investor in those companies. So within our approach, we really think about 3 different buckets of companies. Firstly, we're looking for sustainable leaders. Those are world-class companies able to take advantage of some of the really strong long-term trends that are out there from an environmental perspective. Then there are solutions businesses. These are companies that are providing critical solutions to some of the really big problems and challenges that we face within the world. And then we also have an opportunity to invest in what we call sustainable improvers. Those are companies whose ESG characteristics are good, but where we think they can be better. And that presents some of the most compelling and most interesting opportunities within the portfolio. And that's where engagement with those businesses also becomes really important. So to give an example of one of those leaders, I'd pick out Croda. It's a company based in Yorkshire, but it's one of Britain's best businesses. It focuses on specialty chemicals and particularly has a really strong position within the life sciences market. A really good example of one of its products was creating the excipients that supported the delivery of the Pfizer COVID-19 vaccine. It's been a tremendous long-term investment for us within the portfolios. It's got great pricing power, lots of demand for its products, and really tying itself into the demand for more sustainable ingredients from both life sciences and consumer goods, and to some extent in the food industry, is absolutely key to driving success for Croda. And we think it's a fantastic company that will do very well for many years to come. When we think about providing solutions, I talked a bit about renewables. SSE again is absolutely in that sweet spot. It has a very strong portfolio of renewable assets within the UK, and it's going to be a key part, both in terms of delivering the networks that we need to support the energy transition, and also in providing the power generation that we're going to need that's not going to be coming from hydrocarbons going forward. So SSE, again, a company well positioned to be able to benefit from that. And in terms of improvers, not every ESG portfolio would own Total Energies, but for us, it meets our criteria that we have. We're allowed to invest in energy companies if they generate more than half of their revenues from renewables and natural gas. Total does that, has a very strong position in LNG, and it also has a very significant portfolio of renewables. In fact, its renewables portfolio is as big as that of Ørsted, which is a Danish company that's very well known as one of the leading renewables businesses globally, and it intends, I think, to triple that over the next 5 years. So there's an incredible amount of investment going into renewables, and Total gives us exposure to that evolution away from oil and towards natural gas and renewable generation within the portfolio. And we very much actively engage with the company to push that agenda, to encourage them to drive that transition even faster. In terms of our overall positioning, you can see our top holdings on the left-hand side. I think one of the things to pull out from this is the resilience of the type of businesses which we've got in our top 10. These are companies that very much have strong business models. They're in control of their destiny. They're in position to be able to deliver even if we go into challenging times, whether that's AstraZeneca, whose future really doesn't depend on the economic cycle, or businesses such as Diageo, Relics, SSE, where again, the demand for their products tends to be relatively resilient to the economic cycle. We do have some financial stocks. Again, there we tend to own companies which have either got long-term track records of being very resilient, such as Nordea, a very conservatively run Scandinavian bank, or Prudential, who's effectively running a large savings operation in Asia, which we would say is one of the few markets globally that actually probably has genuine underlying growth opportunities still open to it. When we think about the positioning from a sectoral position, again, we want to have more capital in companies that have got better structural growth opportunities. So while we have quite a big positioning in financials, that's across a wide range of things, from motor insurance, life insurance, asset management, savings, banking, closed life insurance books, a wide range of different things. Some things a little bit sensitive to the cycle, but most things actually being driven by underlying structural demand. And then we've got big exposures to technology, healthcare, industrials, utilities, again, companies that are much more steady, stable, and driven more by structural than cyclical elements. And we tend to be underweight the areas partly as a result of sustainability criteria, but also where we see companies less in control of their destiny. Commodities, energy as well, where again, there is limited pricing power within those businesses. Today, it may be good, tomorrow, it may not be. But we want to invest in the businesses that have more control over their destiny. And you can see on the left-hand side the exposure to mid-caps and small caps and non-benchmark holdings being pretty significant within the portfolio. What have we been up to in 22-23? Well, we've been really looking to take advantage first of a weakness in the number of companies that have been under pressure from a tougher market backdrop. Aveva would be a good example of that. We built quite a big position in that during the first part of the year. It's just been taken over by Schneider Electric. But we've also been building very large holdings in Unilever, which has fallen out of favor, but where we see a very attractive valuation and a relatively resilient business. And I think the kind of thing that's very good for the current environment. Coca-Cola Hellenic, again, very good business, sold off on the back of exposure to Russia, something again which we think offers good positioning. And something like LSE, which had been, again, facing some tricky times as a result of its acquisition of Refinitiv, but where again we see effectively a technology database business that has the capacity to grow almost regardless of the economic cycle, and where the current valuation we see as being pretty attractive. What have we been selling on the other side of that? Well, we exited out of GSK, thought that the residual business post the spin-off of Haleon was pretty unattractive. We sold out of Abcam because we didn't like the governance changes that were going on there. We exited Haleon because we didn't like the balance sheet. We don't like to invest in companies that have got lots of debt. We like companies with strong balance sheets that can put themselves into good positions in this type of environment. So really focusing on opportunities and companies with a lot of resilience, exiting those companies where we're concerned either about balance sheets or about the business franchise over the longer term. But I think important to say what we've got on the left-hand side here is increases. So we haven't actually bought a single new stock during the first part of this year. And I think that should say something about the longer term nature of our approach to investing within the portfolio. And here's the dividend track record. I talked earlier about us increasing or maintaining the dividend every year for 40 years. We have a pretty attractive dividend yield relative to the market, 15 to 20% premium. And it is certainly our ambition over the longer term to increase the dividend in real terms. That's going to be a little bit difficult in an environment where RPI is running at double-digit levels, but nonetheless, it remains our ambition over the medium term to deliver that to our investors. And we have a very strong balance sheet, leveraged in 7 to 8% on a net assets basis, so pretty conservatively structured. Again, important to say that most of that debt is on a fixed coupon basis, so the increase in interest rates we're just seeing make no difference to our funding costs at all. And we have significant revenue reserves and the ability to distribute income out of capital, which puts us into a good position to be able to maintain and grow that dividend, even if we find ourselves in quite challenging economic conditions. Diversification is also quite important from an income perspective. And again, when you look at these companies, quite a diverse range of businesses, some of which you may or may not have heard of. But I think, again, it's important for us to have that spread of different income generating businesses with different drivers and different economic sensitivities within the portfolio. And we also write a number of options which can help generate some additional income. Why should you consider UK equities? The mood music around the UK is pretty terrible. The mood music around the new Prime Minister is pretty terrible. The mood music around the new economic policy is pretty terrible. Well, I think there are a number of things. First of all, the UK PLC generally trades at a pretty cheap price. That hasn't changed much in recent times. UK companies trade at a big discount to the rest of the world, so that is quite important. Secondly, actually, the opportunities within the mid-cap part of the market we see is actually very attractive. The long-term return from the UK mid-cap market has been very good, and we continue to see lots of opportunities in that space. And again, we're starting to see and have seen and will probably likely continue to see overseas and internal large buyers looking to buy UK companies, Aveva being an example, Euro Money being another one that had been taken over during the course of this financial year. So we see M&A, some great businesses, and quite attractive valuations as an important underpin to an investment case in this marketplace. One final thing to say in terms of strategy, very important to remember that you're not betting on UK PLC. 75 to 80% of the revenues of our portfolio, and indeed the market, come from outside of the UK. And I would say that's fundamentally a pretty good thing. And the things that are driving the businesses which we own, long-term consumer trends, I talked about Croda, but we could talk about someone like Diageo with its global brands that it's making money on in the United States or in China. We could talk about the march of demographics, supporting someone like Unilever's exposure to markets like India, Prudential savings opportunity, or healthcare opportunities such as AstraZeneca or Novo Nordisk. Or we could talk about the march of technology, which again, if we can harness that for the portfolio, can be incredibly valuable. Talked earlier about the takeover of Aveva, and Euro Money, but we've also got some other businesses here which are well positioned to take advantage of some of those digital trends going forward. And so when we think about the portfolio overall, undoubtedly we're going into choppy economic waters, but we think with a high quality portfolio of sustainably managed companies, we put ourselves in a good position to be able to navigate this environment. Now, we will not be resilient. We are not an absolute return fund, but I think relative to the market, particularly if we do go into an environment where the economy starts to become a lot weaker and some of the inflationary pressures ease, then I think we'll be in a good position to be able to prove resilient and then also to take advantage of the opportunities that will come out of that. Because the one thing I can guarantee is that if we do go into that sort of tough situation, such as that which we saw in 08, 09, that was one of the best investing opportunities that you would have had in many, many years. And we also need to keep ourselves focused on the opportunities as well as thinking about the risks. And so going forward, a portfolio with very strong ESG characteristics, an attractive dividend yield, a great long-term track record of delivery on growing the dividend, and a portfolio which we think should be able to offer you a good, attractive total returns over the long term, even if we're moving into some choppy economic waters at the current time. So thank you very much.